Today is a Friday, February 7, 2025. U.S. job growth misses expectations in January 2024, unemployment rate steady at 4%. Washington, February 7. The U.S. labor market showed signs of slowing in January 2024, with job growth falling short of expectations. Non-farm payrolls increased by only 143,000 jobs, a significant drop from December's upwardly revised 307,000 gain. The unemployment rate held steady at 4%, but economists warn that the data was influenced by external factors such as wildfires in California and severe cold weather across the country. The latest employment report from the Labor Department's Bureau of Labor Statistics, BLS, revealed that job growth was weaker than anticipated, with economists initially forecasting 170,000 new jobs. The range of estimates varied widely, from 60,000 to 250,000, reflecting uncertainty in the labor market. The report was further complicated by annual benchmark revisions, updated population weights, and adjustments to seasonal factors used to smooth out data fluctuations. Key factors behind the slowdown in U.S. job growth. The moderation in job gains was partly attributed to payback after December's robust performance. Additionally, extreme weather events and natural disasters disrupted economic activity in January. The labor market also faced challenges from policy changes and structural shifts, including the Trump administration's efforts to reduce federal government jobs and spending. Government employment, which includes state and local government roles, has been a significant driver of job growth in recent years. However, reports of layoffs in organizations reliant on federal funding have raised concerns about the sustainability of this trend. Federal Reserve stance on interest rates amid labor market resilience. Despite the slowdown, the labor market remains resilient, with the unemployment rate at 4%. This stability provides the Federal Reserve with room to pause interest rate cuts as policymakers assess the impact of fiscal, trade, and immigration policies. Economists view these policies as potentially inflationary, complicating the Fed's decision-making process. The Fed maintained its benchmark overnight interest rate in the 4.25%, 4.5% range last month, following a 100 basis point reduction since September 2023. The central bank had aggressively raised rates by 5.25 percentage points in 2022 and 2023 to combat inflation. Financial markets are now anticipating a rate cut in June 2024, but the Fed's cautious approach suggests it may wait for clearer signals from the economy. Impact of Trump administration policies on employment trends. The Trump administration's policies, including mass deportations and tariffs, have raised concerns about their potential impact on the labor market. These measures could reduce labor supply and discourage businesses from expanding their workforce due to increased costs. Moreover, efforts to slash federal government jobs and spending are expected to curb employment growth in the public sector. This could have ripple effects across the economy, particularly in regions heavily dependent on government funding. Wage growth and economic outlook. Average hourly earnings rose by 0.5% in January, up from 0.3% in December. Over the past 12 months, wages have increased by 4.1%, matching the growth rate seen in December. While wage growth remains steady, it has not been enough to offset broader economic uncertainties. The labor market's resilience continues to be a driving force behind the U.S. economic expansion. However, challenges such as policy shifts, natural disasters, and inflationary pressures could weigh on job growth in the coming months. Conclusion. The January 2024 employment report highlights the complexities of the U.S. labor market. While the unemployment rate remains low, job growth has slowed, and external factors are creating headwinds. As the Federal Reserve navigates these challenges, businesses and policymakers will need to adapt to a rapidly evolving economic landscape. Thanks for watching and subscribing to the channel.